why don't we get started? I want to welcome everybody to this AFA special session studying the role of finance and COVID-19, and in particular focusing on asset pricing and macrofinance topic today, following on from a session yesterday that focused on corporate finance related issues and COVID-19. My name is Johannes Stroebel. I'm going to be chairing the session today. I want to start out with a quick request from John Graham to remind all of you to take the time to fill out the AFA Work Climate Survey, which you should have all received via email. So the plan for the session today is that we're going to have 5 papers, each studying some interesting aspect of how COVID-19 has affected financial markets. And we're going to have 15-minute presentation for each of the papers, and we're going to have no discussants. So it's a little different to our standard AFA sessions. And then the hope is that at the end, we're going to have a discussion with the authors of the various papers, in which we can address some questions that that you in the audience have about these papers, but hopefully also have a somewhat broader discussion on sort of what interesting open questions for the macrofinance community come out of this sort of specific COVID-19 period. And so the way we're going to do this is in this webinar format. The main way for you to communicate with the presenters is via the Q&A box. And so what I would encourage you to do is, if you have questions on the papers throughout the talks, put them in the Q&A box, but also in particular when we enter the sort of discussion period at the end, if you have questions, thoughts about sort of directions for the field to go, please also put them in the Q&A box. And what I'll try and do is I'll try and find you in the attendees, and I'll try and sort of allow you to unmute and ask some of these questions directly. Other questions which are on papers, I might just directly post to the author. So we'll see how many questions we get and how that works. So with that said, we're going to go to the first paper. So Alan Moreira is going to present When Selling Becomes Viral, Disruptions in Debt Market During the COVID-19 Crisis. Thank you, Alan.
So this joint work with Valentin, Haddad, and Itay and Muir, both from UCLA. And we very much look forward to your questions and comments in the end. The starting point for this paper is the dramatic crash that happened in March as the COVID pandemic was expanding. Here I plot the returns of several asset classes over this period. More specifically, this paper is going to focus on corporate debt. On this chart, you see that investment-grade corporate debt suffered a large price drop of about 20%, about as large as high-yield debt and similar as stocks. These are really large numbers that should be a source of concern. Typically, debt is much more stable than equity. So, for example, doing a very simplistic calculation here, explaining both bond returns with the usual beta on equity, one would forecast a much smaller drop of about only 5%, right? So this is a really big gap. And in this paper, what we try to make progress on why this happened. I'm going to show you a number of more nuanced observations about what went on this debt market during this period. And I'm going to argue that these facts allow us to rule out some explanations of the price movements while suggesting a path to the correct explanation. So in this paper, we're going to find a pervasive pattern of dislocations in debt prices, particularly in the investment grade segment. During the drop, the capital-intensive bonds trade at a discount to CDS, and the usually more liquid ETF trade at a discount relative to the underlying bonds. Both of these prices differences amount to a large share of their overall price drop. So they are not like a sideshow, but they are actually a big part of the price movement. Second, we try to find the specific interventions by the Fed, namely the announcements of bond purchases, and show that they played a large role in the recovery. So these observations tell us what can and cannot be behind these price movements. I will explain more in a moment, but for now, let me just state our main conclusions. The data pose strong challenges to the frictionless explanations based on changes in belief or risk compensation. At the same time, they appear inconsistent with an intermediary-based explanation only centered on dealers. However, the pattern we see line up best with a widespread and persistent selling pressure from various institutions trying to obtain liquidity. I will show some evidence suggests that redemptions from bond mutual funds, as well as liquid demand by corporations, contributed to the drop. While it is still not a full explanation of the crash, this observation considerably narrowed down where we should be looking for more progress in our understanding. So I think the best starting point is an example. So Google, and in particular, a very specific bond, a bond that is 6 years to maturity from Google. And obviously, Google is a very safe company. They have a AA rating. They hold cash well in excess of their financial liabilities. And if you look at their cost of insuring against their default, the CDS spread in the orange line, it also suggests that Google is very safe. The spread stays around 30 to 40 basis points with this whole episode. But the spread at which the bond trades, the blue dots, draw a very different picture. The bond spread spikes to over 150 basis points, meaning that people during this period traded the Google bond at under 90 cents on the dollar. And there is a lot of trade at these prices. Each of these blue dots that I'm plotting here is a trade from the trace data. So this highlights that even for the safest companies, bonds appear to trade at a price well below what one would expect of given their economic prospects or what the CDS market suggests. So this pattern holds much more broadly. Here is the median bond spread and CDS spread across many investment grade bonds on the left, and I'm showing the high yield bonds on the right. Investment grade bonds look a lot like Google, a sharp increase in bond spread that comes back down, not accompanied by a similar movement in CDS spreads. In contrast, within high yield bonds, CDS and bond spreads move much more closely with each other. So the black lines here are the bases, the difference between the two spreads, the CDS and the bond spreads. And it increased both categories by about 300 basis points. So this is not a sideshow to the bond price drop. Rather, it's about 75% of the movement is movement driven by the bases. So if you were trading corporate bond exposure through a synthetic exposure by longing treasuries and shorting CDS, you would have lost 5% and not 20%. So finally, one important remark here is that the similar size for the bases, investment grade and high yield, is very unusual. For example, in 2008, the bases was much larger in high yield than investment grade. This again suggests a particular disruption in investment grade debt. Now, turning to the cross-sectional, you can see that this divorce between bonds and CDS for investment grade is also very visible there. Here, each point is a firm, and the x-axis is the change in CDS spread during the crash, and then y-axis is the change in bond spread during the same period. Most points are above the 45-degree line, consistent with the bases opening up. However, the deviation is much more pronounced in investment grade. In particular, you can see that this cloud of points looking like Google, right? Very little action in CDS, but a lot of movement in bond spread. Another interesting dislocation is between ETF and the underlying basket of bonds that they hold. ETFs have grown tremendously over the last 10 years, and they total around about $1 trillion. And they're usually perceived as much more liquid than the bonds that they invest in. Here I'm plotting the difference between the price at which the ETF trades and the NAV of the price of the underlying bonds. And you can see that the ETFs for investment grade bonds and other forms of safe debt like treasuries traded at a very large discount during the crash. And here again, these are not small deviations. They are as large as 5%, so 1/4 of the total price drop. In contrast, we see no dislocation in, for example, in high yield debt. Now, all this phenomena, the price drop, the opening of the CDS bond basis, the ETF NAV basis, occurred along the same timeline. They peaked around March 20, and the recovery started following specific Fed announcements. And that's what I wanted to show you next. To show that, we are going to zoom in as tightly as we can around the Fed announcements and study the price response. And what we're going to do through the paper, and we're also going to look at bonds, but we're here for the talk, we're going to talk a lot about the ETF response because we have a frequent price observation, which is conducive for the event study. So the first one that I want to show you is March 23. That's when the Fed first announced it to buy corporate bonds. Important, it's just an announcement. The Fed didn't do any buying for more than 2 months. And I'm plotting the cumulative returns across different categories here. You see a very sharp increase in the price of investment grade debt, both short-term and long-term recover by about 6%, 1/3 of the overall price drop. And if you're a fan of elasticities, that's close to a one-to-one response in dollars with the size of the announced facility. So very powerful effects from this policy. And the response is very segmented to investment grade debt. You see no jump in high yield prices, treasuries, or stocks, only the target asset class. So now turning to April 9, that's the oil announcement playing a very large role in this response, where the Fed expanded the programs both in scale and in scope. And this is what some people argue was kind of the whatever take moment of the crisis. For example, yesterday we said Bernanke using this language to describe what the Fed did, and that's where the Fed went basically everywhere, and even in very risky parts of the market. And here you see a large recovery across asset classes. High yield bonds recovered the most by about 7%. Investment grade recovers as well. Even stock market responds to the Fed intervention in this case. We also in the paper look across a variety of other interventions, and we find that they produce no sizable jump in prices like we see for this show. Specifically, we see that announcements designed to relax dealers' short-term balance sheet constraints, such as the primary dealer credit facility and the relaxation of the supplementary leverage ratio, have no effect on price. So all in all, we conclude that the Fed contributed a lot to the recovery, but maybe more interested to understand what happened. This happened through specific interventions. And the two things to take away are that announcements to purchase the future, to announce to purchase in the future boosted prices immediately, while policy designed to relax credit frictions in the dealers had no or very small effects. In the paper, we also look at the cross-section of bond ratings, and they paint a similar picture. I'm going to skip it here for today. So we also ask, using the panel firms, whether the announcement effects were mostly about recovering CDS or in the basis. That is that about broad movements in risk premium or about changes in these locations? And we find that in the cross-section, the March 23 effect was mostly about closing dislocations or the basis, while on April 9, you have a broader effect where both the basis and overall CDS spreads are going down. So now, what do these facts tell us about price movements? First, take fundamentals. This type of explanation is a priori very plausible given the magnitude of the shock, the economic shock, but they just have a hard time explaining what we find. They won't explain why we have similar losses on investment grade and high yield, and why these losses are similar to what we see in the stock market. Worse, they just cannot get and explain why the dislocations itself are an important piece of this price movement. So this suggests us we should look for answers in the structure of financial markets. So one first view would be that the market just completely broke down and trade couldn't happen. This doesn't appear to be true. There was no sharp change in volume. If anything, volume in corporate bond markets went slightly up during the most acute phase of the crisis. A more nuanced view is that the plumbing of the financial sector had difficulties processing these events, in particular dealers. This story is very appealing. While banks are indeed better capitalized than they were in 2008, they have a lot of regulation. So consistent with this, we can see that they are less active than before in corporate bonds. They just don't hold as much in their balance sheet. And if anything, they were getting out of the market as the markets went down, right? But our evidence posed strong challenge to this, simple dealer-centric view, because prices responded to the Fed announcing that they would buy bonds, while the actual purchase took many months. So such an announcement has in principle no direct impact on the dealer balance sheet constraints. So the flip side of this observation is that interventions designed to directly relax the constraints had no effect whatsoever on asset prices. So, and finally, I want to point out that many theories of financial intervention predict a much larger effects of these frictions on high yield rather than investment grade debt. So So what does remain then? It doesn't seem that it's purely about dealers. So our view is that it has to, that this low price reflect a widespread and persistent selling pressure. Usually for a widespread explanation, we would turn to fundamentals, but that also doesn't fit here as we discussed before. So the structure of price movement suggests a path forward. Maybe many institutions were liquidating position to obtain cash. This narrative is consistent with basically investors focusing on more liquid investment grade rather than high yield bonds to satisfy their liquidity needs, and selling bonds rather than insuring with CDS contracts, and even selling first the more liquid ETFs before the individual bonds. We see more hints of that in the data by looking at quantities. In particular, during this period, there was more than 300 billion outflow from bond funds, suggesting that this was an important source of this disruption. So one point that I want to highlight about these liquidations is that they do not need to be immediate to make the price react, right? So rather anticipation of future sales would do it, right? If you go down this path, you get a lot of candidates. Life insurance tend to be slow to sell, and the fragility of illiquid mutual funds might lead to much larger future outflows. And finally, many firms might want to raise debt financing to weather the COVID shock. So this might sound kind of like loosey-goosey and abstract, but I also notice that the reverse is, holds in the data. That is, anticipation of future buying by the Fed dramatically lift corporate bond prices on impact, right? Indeed, we look at the variation in two sources of selling, both realized selling driven by mutual fund flows and future selling coming from firm issuance. And we see that both are important prediction of spreads increasing changes in the cross-section of bonds. And this is true even if you include a variety of controls for fundamentals, such as industry fixed effects, leverage, cash on hand, debt maturity structure, and even the firm level change in CDS spreads. To conclude briefly, there was a massive crash in debt markets, particularly for safer investment grade firms, and large price dislocations with it. The Fed played a big role in the recovery, particularly through policies of the future asset with these policies that promising future bond purchases. And I hope I convince you that these facts help rule out some explanations for the crash, but also can guide future research about them. Frictionless asset pricing, but also simple dealer-centric intermediary asset pricing don't fit the facts jointly. Instead, understanding why many institutions could be liquidating the specific assets at this specific time look like the way forward to understand the events of March. I also want to point out that there's a lot of great work on debt markets during this episode, and we learn a lot from it. Thank you very much.
Fantastic. Thank you very much, Alan. Again, I want to remind the audience that if they have questions about the papers, they should use the Q&A function for that. So the next presentation is going to be Antonio Falato presenting about financial fragility in the COVID crisis, the case of investment funds in corporate bond markets. So again, helping us understand the debt side of COVID-19. Antonio, floor is yours.
Thanks, Johannes, for taking the paper. And this is joint work with Itay Goldstein, who is also here today, and Ali Hortacsu. So what we do in the paper is really it's to use high-frequency, real-time microdata on bond funds and ETFs with three main goals in mind. So the first goal is to try to get a feel for sizing up how big the COVID episode and the March 2020 dislocation was for these investment vehicles, for bond funds and ETFs. So the first goal is, again, sizing up the episode. The second goal is to get a feel for the factors that drove the episode. So in some sense, if the first question is where were these funds fragile, the second question is really why were they fragile and which funds in the cross-section were more fragile. And the third goal is to try to get a feel for what worked in terms of the policy response and what's the Fed response, the Fed intervention, how did it affect funds and was it effective at mitigating some of the fragilities during the episode. By way of quick background, So why do we care? Why do we think these are important questions? Well, as a matter of fact, over the last decade, so since the global financial crisis, these investment vehicles, so bond funds and ETFs, have become important players in debt markets. So these guys have gotten big. So to get a feel for how big they got, so what we are charting here is over the last decade, we are really charting the size, the relative size of these instruments, of these investment vehicles relative to the overall size of the market. So we're plotting the share relative to the overall outstandings in corporate bonds of the net asset value in the aggregate of bond funds and bond ETFs. As you guys can see, there's clearly that the size of bond funds doubled over the last decades. So relative to the overall markets, they were less than 20%, and they are now more than a third of the market. So clearly these bond funds have become big players in these markets. Now, to start as a first step, to get a feel for the size, so sizing up the episode, so were these instruments really fragile in the COVID crisis? What we are charting here is on a monthly basis, the aggregate net flows. So this is, so positives in these charts are net money that goes into the funds, and negatives are redemptions, is money that's going out of the funds on a monthly basis. And this is plotted as a percentage of the lagged net assets of funds. So clearly, on average, most of the bars are positive. So this sector has been experiencing, consistent with what I just showed you, has experienced growth on average. The red line is showing the February 2020. So clearly the two big drops, the two big negative bars to the right of the red line are showing that in the COVID crisis, there were big outflows out of bond funds and ETFs. And these big outflows were big. So clearly the size of the bars is in the range of 5 percentage points. So the outflows that we saw from bond mutual funds are quite unlike anything we've seen over the last decade. So there were large outflows, in some sense unprecedented large outflows. And as it turns out, these outflows were more pervasive than anything we've seen before. So I'm charting here is again on I'm doing it now on a daily basis, and I'm going a bit more into the cross section, and rather than charting the aggregate outflows, I'm charting the percentage of funds. So this is looking at sort of the fraction, how many funds on a daily basis experienced large outflows on net. So as you guys can see to the right of the red line, so in the COVID crisis, more than a third of funds for very many days, for more than 1 day on a sustained basis, experienced very large outflows. So clearly the dislocation affected funds across the board and way more, so it was in some sense way more pervasive than anything we've seen before. Again, for historical reference, you do see some peaks before, and the highest peak you see in this chart is toward the middle of 2013, and that's the taper tantrum. So for reference, in the taper tantrum, you do see less than 20% of funds experiencing large outflows, but again, that's less than half than what we saw in the COVID crisis. In the aggregate, it was a 5% drop in the COVID crisis in flows relative to a less than a 2% drop. And on average, these patterns are even more dramatic. So the average fund in the COVID crisis experienced a 9% percentage point outflows over the February to March period. And for reference, in the taper tantrum, the average fund at the peak of the crisis did experience even a 2%, less than a 2% outflows. So clearly, the COVID crisis was a big shock for the bond fund sector. Finally, to look a little bit more into the timing of the episode. So what we do here is zoom in 2020. So rather than looking at the longer perspective for the last decade, I'm looking at the months around the crisis. And I'm again looking at now on a daily basis, we're showing aggregate flows as a percentage of net assets for the sector. And as the chart is showing from the daily pattern, what you can see from the different, so we're doing a little bit of a timeline of the crisis here. So clearly you start seeing the first negatives around the end of February. So the outflows started late in February, and they really took off toward the middle and then the second half of March, and they really accelerated then. And they really didn't start to slow down until the first big policy announcement on March 23rd, which was the first Fed announcement of the corporate bond facilities, purchase facilities. And they really didn't fully reverse until the second. So it took the second announcement of April 9 by the Fed. The second announcement involved expanding the facilities and in some sense signaling that whatever it takes approach of going deeper into the taking credit risk of the fallen angels on April 9. So it took the second announcement for the second Fed announcement for flows to fully reverse. Now, starting to go a bit more deeper into the cross section and to think about what we learned from the episode in terms of sources of fragility. So again, why? So again, I hope by now I convinced you that this was a big shock. These funds were indeed fragile in the COVID crisis, but which funds were fragile in some sense? Why were they? So in terms of what Peary says, we think that there's really two main reasons to think about why funds should be expected to be fragile. The first reason is liquidity mismatch. So Itay has done work earlier on, thinking about liquidity mismatch. And the reason, the thinking here, the reason for fragility here has to do with the fact that there's a mismatch between the fact that this vehicle on average hold assets that tend to be illiquid, but promise redemptions on a daily basis. So the assets and liability, there's a mismatch between the liquidity of assets and liabilities of these vehicles. And the mismatch creates an incentive to run because redemptions today impose costs, liquidation costs on redemptions tomorrow, which creates an incentive to run today. Another source of fragility is related to more recent work that we did with Ali and co-authors we've been doing on the fire sale vulnerability. And again, here, still the reason has to do with the liquidity of the holdings and the fact that redemptions today have a price impact and are costly. But now the nature of the cost is different because rather than being a cost on future redemptions, this is a cost on redemptions at Fund I on redemptions at Fund J. So redemption at Fund I are costly and create incentives for run at Fund J. So this is a vulnerability to fire sale across different funds. So we think that these two reasons, so sometimes what's good about these two reasons is that they're testable. So the main testable hypothesis that comes out of these sources of fragility is that then if we rank funds based on the liquidity of their holding and their vulnerability to fire sales, we would expect to see more outflows in the crisis by funds that are more illiquid, that hold more illiquid assets and are more vulnerable to fire sales. So to get at that in the data, what we do is starting with the illiquidity, we do very simple sample splits. So we use very naive, very simple measures on ranking. So we rank funds based on the liquidity of their assets, and we split the sample between funds that are ranked as most liquid or most illiquid in terms of their asset holdings. If you do that, looking at the sort of similar timeline of the crisis as what I've shown you in the figure in the chart before, you see a very clear pattern. And this is robustly across different ways of ranking funds based on their liquidity of their assets. So clearly, for the more illiquid, for funds that held more illiquid assets, you see you see the outflows starting early. So earlier in the crisis, they started experiencing large outflows, and and despite the earlier large negative, so the earlier outflows, they kept seeing very large outflows until mid to late March, until the first Fed response, the Fed policy announcement. And it really, the outflows didn't slow down and didn't fully reverse until the second also for the liquid funds. In fact, looking at column 5 and 6, if we rank funds based on the in some sense riskiness of their asset holdings, of their bond holdings, really the funds the more risky funds, those that were holding worse rated bonds, are those that benefited the most from the second Fed announcement. So we didn't see a rebound a significant rebound for those funds until very later on. And same exercise, if you when we repeat the exercise and now split funds based on their vulnerability of fire sales, we see a very similar pattern. So again, more vulnerable funds experienced larger outflows early on. They continue to experience very large outflows until the middle of the crisis and the peak of the crisis, and no reversal until later on. In the last part of the paper, what we do is finally to look at, in some sense, what worked in terms of addressing whether the Fed policy actions that were unprecedented helped to not only stabilize the bond market, as other work has shown, but also in which way they sort of affected funds in the market. So the thinking here has to do with the fact that sometimes if you buy the premise of what I've been selling so far, that there are these issues of fragility that are related to the illiquidity of the holding and fire sale vulnerability, then in some sense the Fed purchases, and by providing a liquidity backstop to bonds, really work as a liquidity backstop also for funds. So the idea here is that because of the liquidity backstop that the Fed is providing, we think that the Fed facilities should have been effective and may have been effective also at stabilizing funds and reversing outflows. So to get at that idea empirically, the way we do it is we now again cross-sectionally rank funds based on their exposure to the Fed facilities. And the exposure, the measures of the ranking of them based on exposures has to do with effectively how much each of the fund holds of bonds that are eligible. So the fund that holds a lot of bonds that are eligible for Fed purchases is going to be ranked high, as highly exposed to the facilities, and vice versa. A fund that holds very few bonds that are eligible is going to be ranking low in terms of exposure to the facilities. And what we do is now we look at the full post-crisis period. So we look at the April to end of August period, and we look at the cumulative flows of funds over this period. And we ask empirically, do we see that effectively funds that rank high in terms of exposure to the eligibility, so funds that hold a lot of bonds that are eligible for purchase by the Fed, experience differences in those. So in some sense, they experience a larger rebound in their flows. And the answer is yes. So the positive numbers, so we get very significant. So the share measure is again the ranking based on the ownership. How much of the holdings of funds are exposed to the Fed purchases, or to bonds that are eligible for Fed purchases. And the positive estimate, coefficient estimate, means that in the cross section, funds that held more bonds that were eligible for purchase experienced larger inflows. And 2.8 or so in the column 1 means that it's a big number. So what it means is that on average, in terms of cumulative flows, a 1 standard deviation higher exposure leads to about 3 percentage points higher cumulative inflows for a fund. So overall, the sector rebounded. So on average, cumulative flows over the post-crisis period were about 8%. But again, there's a significant higher rebound. So the rebound was really driven by these funds that held eligible bonds. So in this sense, the liquidity backstop for bonds effectively worked as a liquidity backstop to stabilize funds. And the final set of results that we do is to take these in some sense one step further and to look a little bit more in depth at the transmission of this unconventional monetary policy via funds. So there's been a lot of work on the transmission of unconventional monetary policy via banks. We don't know much about transmission by non-banks. So the last step of the set of results that we look at is in some sense what we call spillovers. We try to see whether not only the eligibility worked in terms of stabilizing funds that were exposed to these eligible bonds, but also whether it worked to stabilize securities, so bond issuance. In some sense, the fact that in the end, the Fed ended up just making purchases in the secondary market helps us here because we see spillovers via funds also in the primary markets. And we also see spillovers to other funds that have holding overlaps with funds that are exposed to the Fed facility. So in some sense, we see a lot of results that point to funds spreading out. So we think that we can provide an explanation of why we saw such a big and pervasive rally. That has to do with the fact that funds were stabilized. So the benefit of the Fed facility in terms of stability of funds, we think provides an explanation, can help to understand why the Fed facilities were so effective, at least in the COVID crisis. So just to summarize, at least to our eyes, what the COVID crisis does is really crystallizes how fragile these bond funds are as investment vehicles, and it helps to understand why they're so fragile. So it highlights some important sources of fragilities that have to do with liquidity mismatch and vulnerability to fire sales. But it's a good laboratory to start understanding and make progress on understanding the transmission of monetary policy and the effectiveness of unconventional monetary policy and how it affects this, and it transmits also via non-banks, not just banks.
Perfect. Thank you very much, Antonio. We're next going to have Stefano Giglio presenting Inside the Mind of a Stock Market Crash. And again, to the audience, if you have any questions here, just type them in the Q&A box. Stefano.
Yeah. All right. So first of all, thank you very much for having the paper on the program. This paper is joint work with Matteo Maggiori, Johannes, and Stephen Utkus at Vanguard. And what we do in this paper is we study the evolution of beliefs and trading of investors during the COVID crash. So let me start by kind of giving like the question we addressed in this paper. We basically asked the following question: how do stock market expectations and trading activity evolve during a large stock market crash like the one we've seen recently? And this paper really builds on a collaboration that has been ongoing for several years now with Vanguard. And in which we kind of specialize to this kind of COVID crash question. So because we built so heavily on this collaboration, let me tell you a little bit of background. So we have started in 2017 running a survey of Vanguard investors, which runs every 2 months, and in which basically every 2 months we contact a large number of investors, and we ask them a very short survey, and in which we obtain on average around 2,000 responses for each wave. So 6 times a year we observe the responses of about 2,000 people. And one of the advantages of this survey is it's quite short, and that kind of means this does not disincentivize people from answering several times. So what we see in our survey is we see the same people very often responding many times. So we're going to have a true panel dimensions that we're going to exploit in some of our analysis. What do we ask in our survey? We ask a few simple questions about expected returns and about GDP growth mainly, okay? And in this paper in particular, I'm going to focus on 2 of them. I'm going to focus the question on what's the expected return of a diversified stock market index for the next year, what's expected GDP growth in the short and the long term, and what are probabilities of extreme events. In particular, we ask the survey participants what is their assessment of the probability of a large stock market drop of more than 30% over the next year, and of a GDP drop of more than 3% a year for the next 3 years. So when we designed the survey, many years ago, we had in mind exactly the possibility that, looking particularly at rare disaster might be important. And so we're going to be able to think about how these beliefs about kind of extreme, negative shocks evolved during the COVID crisis. So these are the main questions we're going to ask. And the other big advantage we have in our survey is that we can link it to administrative data from Vanguard on the trading and portfolio activity of all these investors. So basically, for every investor we did survey, we observe the entire activity in Vanguard. And out of this project, we have written a paper called 5 Facts About Beliefs and Portfolios that tries to distill some interesting patterns, which are kind of not specifically COVID related, they are kind of general patterns. And in this paper, we're going to explore how these patterns look like during the February to April COVID crash. So let me tell you a little bit, first of all, about the timing of our survey. So what you see here is, the months between January and April, and the solid line you see here is the S&P 500 price level. And you see 3 gray bars here, and the 3 gray bars are the timing of our survey. So as I told you at the beginning, we're running a regular survey every 2 months. So you see there are 2 bars called regular wave. Those are in February and April. Those are the pre-scheduled surveys. One just happened at the very beginning, just before the beginning of the crash, so in mid-February. And one happens, as you can see, in mid-April, throughout the midway throughout the recovery. In March, we saw the stock market drop, and we activated a feature of our survey that we had designed, we built in at the beginning many years ago, which was, we had the ability to just run a flash wave, basically within a very short amount of time, within a day or two from when we activated it. So in March, we saw the stock market dropping like a rock, and we decided to activate it. And so you can see that we basically are able to time this this intermediate wave pretty close to the bottom. Okay, so we're going to have basically 3 ways of analyzing this paper: one just before the crash, one basically almost at the bottom, and one throughout the recovery. And this gives us a nice picture of how investors' beliefs evolved during this time period. So let me just now jump into the data directly. I'm going to start by showing you the time series of the average expected return over average across all of our investors. Okay, so as I said, our survey started in 2017, and so you can see that throughout this period, the investors' beliefs have been relatively stable at about 30% per year expected return. But you see a few swings throughout. But interestingly, you see a peak basically just before the crash. So this is the February wave here, and you see the investor expectation were at the peak of 6%. And then the crash happens, and investors' beliefs kind of immediately become more pessimistic, dropping all the way to about 1% on average. And interestingly, even with the recovery of the stock market that happened in April, you still see the expectations did not recover. They stayed around 2%. Since then, they've recovered a little further, but it were kind of much slower than the recovery of the stock market. This figure here shows kind of the other side of this, which is the probability of a large crash in the stock market. Okay, again, it's a 30% drop over the next year, and you see, this is a kind of rare disaster. The average response is about 5%, which is kind of very close to what you see in the data historically. But when the crash occurred, investors did expect a further crash with a much higher probability of about 8%. If anything, that increased in April. Okay, so this basically has been a very strong shift in expectations and perceptions of risk after the market dropped. Okay. And so those results were about returns, and I'm going to now show you something about instead the expectation of GDP growth. GDP growth expectation did drop also during the crash, but they dropped much less than returns dropped. If you look at the axis here, we're going to from about 2.8% to about 2.2% per year. Okay, it's of course it's a drop, but it's a much less significant drop. And I don't have it here, but if these drops were concentrated at the short end, there's much less action going on in the long end. Okay, so if I had to summarize what happens to the average belief during the crash is really a bout of pessimism, basically, both about the GDP growth, but especially about stock markets. Investors just became incredibly pessimistic after observing this 20% drop in March. So that's about the average behavior. There's a lot of interesting heterogeneity that we see in our sample. Okay, so first of all, here what I want to show you is the histogram of the responses to the question, what do you expect the return to be over the next year? You can see there's a dashed line which is different from the others. That's the February way. That's a February histogram. So you can see that in February, most of the responses were concentrated between 0 and 10%. And what happened in March and April is you can see a very drastic dispersion of beliefs. So there's much more disagreement between investors about what to expect for the future. In particular, there's a thickening of the left tail. So now there's many more investors become very heavily pessimistic and expect a more than 20% drop in returns going forward. Okay, so there's not just that on average the beliefs have shifted, but there's also been an increase in the dispersion. Okay, but what's really interesting, so these are aggregate patterns. What's interesting about our survey is that we can actually do a much more sophisticated heterogeneity analysis, because we can track individual people over time because we have this additional panel dimension. So here's what we do, I'm going to show you now, is we look at February, and as of February before the crash, we can sort people into buckets of optimists. So we're going to have the optimists, the slightly less optimists, so on, up to the very pessimists. And then we track how each group of investors behaved over time, how their beliefs change over time. So their main table on this segment of the paper is this one. So let me kind of go slowly through it. So here on the left, you can see the 4 rows. The 4 rows correspond to 4 buckets of investors. So the top row is the most pessimistic. In February, they believed the expected return was less than 0% going forward. So they already expect the markets to drop going forward, all the way to the optimists at the bottom, which expected more than 10% returns over the next year. Here in the table, what we look at the change. So in a sense, the revision, their expectation between February and March. And in particular, we have several buckets of revisions. For example, when you see less than minus 20, it means that those are investors that revise downward their expectation by more than 20 percentage points. Between minus 10 and minus 20 means that they revise their expectation by more between 10 and 20 percentage points and so on. And the numbers you see in the table are basically the mass of each bucket that change in that particular way. So for example, let's look at the last row. These are the ones that are in February optimistic. Of those that were particularly optimistic, 4% became significantly more pessimistic by revising downwards by more than 20 percentage points. 29% became more pessimistic by revising downwards by 10 to 20 percentage points and so on. So basically, if you look at the first 4 columns, those correspond to people who became more pessimistic. So those are the mass of people that became more pessimistic. And the last 2 rows are the mass of investors that became more optimistic. And a very striking pattern here is that, almost all the groups became very significantly more pessimistic. So on the very right end here of the table, you can see the share of each bucket that actually become more optimistic. So you can see that, for example, from those that in February were optimistic, only 13% actually become more optimistic, 87% become more pessimistic. And you can see that for all groups, almost all groups, a vast majority of investors becomes more pessimistic. So that's what I said before, there's an aggregate wave of pessimism. But there's an exception, and the exception is those that ex ante were pessimistic. Those who were pessimistic actually, on average, tend to become more optimistic. So let's say more or less half of them, they remain pessimistic, and some of them become more optimistic. In a sense, an interpretation of this could be that, those were investors already expected the crash, and they kind of felt vindicated by the crash, and further, they didn't expect kind of more crash going forward. Okay, and that's just not driven by mean reversion. That's a pattern is actually due to really the change in many of these pessimists, their change in beliefs. So this is our main patterns of beliefs over the crash, which is kind of quite heterogeneous across groups. And the last thing we do in the paper is we look at trading. So in particular, we kind of do the same analysis. We ask what happens to trading on average and what happens to trading by group of optimism. And the very first quite striking patterns that you see in the aggregate in our data is that only 30% or around 30% of our investors actually trade at all. So for 70% of the investors, despite the fact that you have this huge change in pessimism, they just don't trade. Okay, so there's a large amount of inaction. Okay, those that do trade on average do seem to trade out of equity and bonds like you would expect and go into cash. But the first order striking pattern is that many investors just don't trade. Another striking pattern is that if you look at those that do trade, in fact, even those that do trade, they change their portfolio very little. So the average active flow out of equities overall is about 1% of trades of equity shares at at most 2 or 3% is a change even among those that do trade. So even among those that do trade, there's very little change. And I want to focus my last few minutes of the presentation on this last fact. So this picture is a picture that basically tracks the equity shares of different types of investors across time. And we've again split our investors in groups of optimists. So basically this line that you see at the top, the dashed line you see at the top is the equity share of those that in February were optimists. These were kind of the middle bucket, and these at the bottom are again the equity share of those that in February were the most pessimists. As before, in the picture before, the solid line is the S&P 500. So I want to emphasize that the changes in equity share I'm going to plot in this picture, they are not due to changes in prices. We keep the prices fixed to their January levels. So all the equity changes in equity share you see here, they're all due to active trade. Okay, that's something we can do because we observe the actual trades every investor is making. And so there are two things I want you to notice. First of all, let's focus 1 second on what happened before the crash. Before the crash, optimists and pessimists already held quite different portfolios. On average, optimists held about 68% of their portfolio in equities, and pessimists on average held 58% of their portfolio in equities. That's something we documented in the other papers, that in normal times, there is quite a significant difference, though the market is not as large as you would expect, but there is a difference between portfolio holdings of optimists and pessimists. But in this paper, we want to focus on how these portfolio shares change throughout the crash. And I want to also emphasize that this picture only focuses on those that actually trade. Remember, 70% don't trade at all. Now let's look what happens to those that do trade. Well, first of all, you do see the equity shares do decrease, but they decrease by small amounts, okay? So first of all, if you look at the bottom of the picture, the pessimists almost don't change their equity share at all. I mean, that's consistent with what I showed you before. The fact that on average, half of the pessimists become more optimistic, half become more pessimistic. So, it's reasonable to expect that on average, the pessimists wouldn't actually change their portfolio shares. Where you see the biggest change is among the optimists. The optimists, remember, became much more pessimistic, and indeed they do sell equities. But look at the magnitudes, they only go from about 68% share to about 64% share. And again, this is only for that 30% that does trade. So you do see that indeed there is heterogeneity in the behavior, both in beliefs and in trading during the crash. But you also see that it's quite muted. Okay, so there's the drop in equity shares is relatively small. So this completes our picture of the empirical facts, both on beliefs and trading. Let me just close in a couple of minutes about what do we learn from it. What can we learn about our theories? And I want to emphasize that I think the COVID crisis is a particularly interesting time period to look at, because it's true it's kind of a very rare event and unique in many senses. But in all of our theories, these very large crashes, they carry particular weight. They're important for welfare. They're important for ex-ante decisions. So it's very important to study these, I think, and to link what we learn empirically to what we can learn from the models. And so what do we learn from the pattern of beliefs? Well, first of all, there's this striking fact that people become very strongly more pessimistic just after observing a huge crash. That's very consistent with the extrapolated expectations literature. You also see an increase in perceived risk of disaster, which is consistent with many of the features we see in rare disaster models, where the dynamics of rare disaster are interesting. And as the disasters occurs, people tend to learn about them, or they become more salient and expect further disaster going forward. Again, that's very consistent with this story. But we also see a lot of disagreement, a lot of interesting heterogeneity, which I think should push us to kind of beyond standard representative agent macrofinance models and towards taking heterogeneity more serious in this kind of models. And finally, we saw something very interesting with dynamics of trading that I would just summarize as saying there is an incredible amount of inertia in kind of going from beliefs to action. We documented this in the previous paper in normal times. It's in a sense even more striking that's true even in such interesting crisis times where belief certainly moves very significantly. People were paying attention to stock markets. And so why did we not see this transmitted into actions? It's an interesting question going forward, and that we're going to leave to future research. Thank you very much.
Thank you very much, Stefano. So the next presentation is going to be Vadim talking about whether or not the COVID bailouts can save the economy.
Thanks, Johannes. I'm going to share my screen right now. Thanks again, Johannes, for putting our paper on the program. This is joint work with Tim Landwood, who's also on the call, and Stan Van Nieuwenburg. So in this paper, we are going to try to provide a framework for studying the effectiveness of the various government policies to support credit to firms during this pandemic in general equilibrium. So as we've seen from kind of other papers and the news for the past year, the COVID pandemic has shut down large parts of the economy. And as a result, many businesses are bound to fail without government assistance. They, absent revenues, they can't pay their wages, can't pay fixed costs like rent, service their debts, and whatever liquidity cushions they have will be quickly exhausted, especially that's the case for small firms. And kind of thinking in GE past just the firms, there's a danger that the wave of firm defaults can break the financial system, creating this doom loop of corporate defaults, leading to intermediary failures, leading to collapse in the ability of intermediaries to extend credit to even other borrowers, right, to other credit markets such as household markets. And anticipating some of these, there's been a large set of government intervention to support businesses. Particularly, there's been direct lending to firms through the Paycheck Protection Program, the Main Street Lending Facility, and a slew of corporate credit facilities at the Fed. So we want to know how effective are these policies and what their long-term fiscal costs are. So to answer these questions, we're going to quantify the effectiveness of these programs relative to a do-nothing counterfactual in which the government pursues its standard set of countercyclical fiscal policies, but nothing additional specific to firms in response to the pandemic. So we'll base our model on a macro model with firms, with intermediaries, and government, kind of the three players key to analyzing questions like this that we've done in a previous paper. And on top of that, we're going to map these government programs to the model one by one, and also study their combined effect on kind of the macro, the financial, and fiscal impacts. So to give you a preview of the results, collectively, these programs are effective. They soften the contraction by mitigating about 40% of corporate defaults. They lead to a third smaller drop in GDP and consumption, integrating along the whole recovery path. The decline in investment is half as big as it would have been absent them. And absent them, there have been a large wave of intermediary defaults that doom loop would have realized. Now, interestingly, and kind of as a consequence of that intermediary failure result, there's the same rise in government debt with and without the lending programs. Effectively, the money that, if the government hadn't pursued these programs, the money that they would have saved not pursuing them, they would have instead had to spend supporting the financial sector that would have been crippled by the wave of defaults. We also can look at these programs one by one to see which of them are most effective. And we find that kind of the most effective features are guaranteed forgivable loans, or in other words, a program like the PPP. In contrast, secondary market interventions in corporate debt have the smallest positive effect. We can also compare these programs to kind of an alternative in which these funds are much better targeted, targeting specifically the firms who really need the money. And we find that kind of that idealized program would be slightly more effective, but of course greatly reduce the fiscal cost. Let me briefly tell you about the three different categories of the programs. So the PPP, the program probably got the most attention in the press, right, is about 3% of GDP program that provides loans for 2 years at a 1% interest rate. And crucially, 100% of the principal is forgiven if the money is used for payroll. Now, banks originate these, the Fed provides financing, and Treasury guarantees losses. So banks don't face any losses. The MSLP, the Main Street Lending Facility, it's a similarly sized program aimed at larger firms. Banks still originate, but now they retain some risks. The program is only partially guaranteed by the government. The pricing is closer to market rates. It's LIBOR plus 3%, and there's no principal forgiveness. This money does need to be repaid. Lastly, the corporate credit facilities, these are a set of programs of the Fed that earlier presentations talked about. It's about 4% of GDP. These are, of course, aimed at largest firms and mainly consist of purchases of investment grade bonds in primary and secondary market at market interest rates. So a model with intermediaries, the government, and firms, it's kind of a well-suited lab to evaluate these interventions in GE. Don't have time to go through the model in detail, but let me kind of give you a diagrammatic sketch. There are two types of households. There are borrowers and savers. And borrowers own two kinds of firms. First, you have the producers who produce a consumption good from the capital stock that they own, and they finance that capital stock with kind of their equity, but also they lever that equity up using corporate debt. They borrow from intermediaries and from the other type of savers. So intermediaries are another type of firm, right? They lever their equity using deposits to extend these corporate loans to producers. Lastly, there is a government that pursues a kind of standard set of fiscal policies, collecting taxes, incurring government expenses and transfers. They borrow from the savers, and occasionally they also bail out intermediaries if intermediaries go in default. So there's, of course, much more detail in the model, but I'll kind of leave the sketch here. Now, absent anything related to COVID, there are two sources of aggregate risk in this model. First, there is a standard TFP shock. But on top of that, there's also persistent dispersion of idiosyncratic productivity. So all of these productive firms draw their own idiosyncratic productivity, and the dispersion of it varies over time. And in our other paper, it's a transition to low TFP shock and high uncertainty, right? This high dispersion regime that generates deep recessions by setting off a double financial accelerator. So to conceptualize COVID, we're not going to do anything epidemiological. We're going to just kind of describe it as a set of exogenous, more kind of macro familiar parameters. So a COVID crisis will be the transition to this high uncertainty regime, which of course is expected. It's in the information set of the agents. But on top of that, there's a set of unexpected kind of MIT components to this shock. The uncertainty is even higher than it would be in the high uncertainty state. So the dispersion is greater, firm productivity is lower, and labor supply is lower as well. And importantly, there is also a belief component to this shock. Prior to the shock, agents believed that pandemics occur with 0% probability. Now, having seen one occur, they revise those expectations to believe that the probability of a pandemic in any given year in the future is about 1%. And once it hits, it's expected to last about 2 years. You could think of the Spanish flu being about 100 years ago. Now, why this combination of other shocks? We think of the low productivity and the labor supply components as representing the effects of the economic shutdowns. And of course, the additional dispersion is because the pandemic does not affect everyone in the same way. Right? Some firms, relative to the overall decline, some firms benefit. Grocery stores benefit. Zoom has benefited quite a bit. Other firms, of course, particularly the travel industry, right, they're hurt even relative to the overall decline. Now, to see kind of how defaults work and where a government program could help, let me kind of focus in on the part of the model that deals with corporate defaults. So let's think of the problem of the producers within the period. They wake up and see the TFP shock realized. Based on that, they choose their labor input and they pay their fixed costs. Then idiosyncratic shocks are realized and they actually produce subject to these shocks. If they don't produce enough to cover their fixed costs and their labor costs, they will experience a liquidity default. Firms that are default are replaced by the borrowers, and then at the end, all the capital structure decisions like dividends, equity, debt, etc. are made. So zooming in on that second stage, right, there's a flow profit for these firms pre-tax, which consists of revenues, which have this idiosyncratic and aggregate component, plus the factors of production, less their wage bill, less debt service, and less fixed cost of operating. And this, of course, suggests that there's a threshold level of productivity such that if firms experience an idiosyncratic shock below that threshold, they don't have enough resources to repay, and they default. You can kind of solve for this, right? It's straightforward. It's the cost divided by the aggregate component of the revenues. Now, if at this time you extend additional, what we call bridge loans to these firms, basically a way for them to borrow at stage 2 and then repay at stage 3, that effectively reduces how much they need to repay at this stage. So we call these bridge loans because they're extended at 2 and repaid at 3. And if you make them proportional to the wage bill, they effectively decrease this threshold by a certain fraction. And with a lower productivity threshold, fewer firms default. So we introduced the kind of notion of bridge loan to capture the PPP and the MSLP program. As in the real world, these programs, these bridge loans can be guaranteed, right, by the government against losses. They could also be forgiven for the borrowers. And both programs can be partial, could be full forgiveness, zero forgiveness, something in between, and they can interact. So now kind of having set up these bridge loans, we could map the programs I told you about into the model. So the PPP here is a fully forgivable, fully guaranteed program with a 1% interest rate. The MSLP is about a similar size, higher interest rate, partially guaranteed, not forgivable. And those are both bridge loan programs. The credit facilities are implemented as standard government purchases of corporate bonds in that third stage when firms make all their capital structure decisions, decide to kind of issue new bonds. Now, the combo program, right, that's the one that resembles what actually happened in the world. that combines the PPP, the MSLP, and the corporate credit facilities at the same time. On top of that, we also consider kind of a theoretically motivated benchmark. So one benchmark is what if the government does nothing? The other benchmark is what if the government does kind of an ideal thing in which they can condition both the size of the loan and who receives the loan on the idiosyncratic productivity. Essentially perfect targeting of funds to the most distressed firms, to the firms that kind of experience the worst shocks. Now, the informational requirements to implement such a program mean it's not a realistic one that we kind of expect the government to be able to implement, but it's a useful framework to see how close did the government get to this benchmark. So let's see some results. In the do nothing scenario, right, if the government doesn't introduce these programs, the COVID shock is quite severe. There's a wave of defaults leading to a lot of deadweight losses. Investment falls off a cliff, and it takes a while for GDP and consumption to recover as a result. The primary deficit, right, the government deficit still spikes because of these additional expenditures government needs to take to preserve a financial sector. Right? That's kind of built in, and it takes a while to pay those off. Relative to the do nothing scenario, the combo, right, the introduction of all the programs that we saw in the data leads to about half as big drop in investment, kind of faster recovery in GDP and consumption, much lower deadweight losses because a lot of defaults are forestalled, and a similarly sized primary deficit because this introduction of these programs prevents a lot of defaults and kind of saves the financial sector. Now, on top of that, if you then go to this ideally targeted program, right, to, as you can see from this deadweight losses, effectively stop all corporate defaults, that program leads to slightly smaller drop in investment than the combo program, similar paths for GDP and consumption. So in other words, it's slightly more effective, not that much more effective, but it's much cheaper. The spike in primary deficit is a lot lower because the government doesn't effectively waste money lending it to firms that don't need it. Now, if we look at the kind of the in-pandemic effects and we focus on the financial effect, you'll see that the programs that really work are the PPP and the MSLP, these bridge loan programs. They're the ones who lower the default rates enough to stabilize the financial sector. Relative to that, the corporate credit facilities are not that effective at lowering defaults. There's basically no change. But kind of consistent with other papers we saw today, there is a price effect, right? Spreads go down, and that lifts the value of intermediary assets and has some kind of saving effect on the intermediary sector. The combo program by design, the combo program lowers default rates quite a bit, also lowers the loan spread, and really saves 80% of the intermediaries from defaulting. By design, the conditional bridge loan program, this kind of CBL, right? That's the idealized benchmark, leads to no defaults, right? We constructed it to prevent the defaults, and that of course leads to far fewer intermediary failures and a much smaller drop in intermediary assets. Welfare is always a little challenging in models like this with two agents, but we could think of them kind of one by one. First, the borrowers, they're the ones who really benefit from this program. Absent it, their consumption drops by 20%. With the combo program, it drops by less than 15%. There's a big boost from this program. Savers, as you can see, their consumption actually goes up as a result of the shock. And this is, in models like this is a telltale sign of a breakdown in financial intermediation, right? Savers effectively can't, or the distressed intermediary sector can't route savers' funds into the productive sector on the other side of their balance sheet. So savers cannot save, they consume instead with kind of the fairly high EIS that we model. Long-term, of course, this consumption now means less consumption in the future, so their individual welfare still goes down. Putting everything together, we think of kind of measuring welfare by looking at how much would both types of agents be willing to pay in sum one time to switch from a world in which the government does nothing to a world in which the government pursues one of these policies. And as you can see that in this right pane, agents would be willing to pay about 6.2% of pre-COVID GDP one time to be in a world where this program is pursued. Now, they're willing to pay slightly more to be in a world with this idealized conditional bridge loan program, but not that much more. So the difference between these two isn't so much on the total effect, it's really about the fiscal impact. So if we look at kind of the cost of these programs, right, the combo program, that's a program that has a really large cost because a lot of this money is being lent, a lot of it is being forgiven. Relative to that, the conditional bridge loan program is a lot cheaper because the funds are only going to the kind of targeted firms. But if you compare the combo program instead of to that benchmark to the do nothing benchmark, you'll see that the effects are really a substitution. If you don't bail out the firms, you will have to bail out many more of the banks, such that the total change in primary deficit, the total increase in primary deficit is actually smaller if you intervene at the firm stage rather than waiting to intervene in kind of the intermediation stage. So to sum up, we've proposed a quantitative evaluation of the government lending programs pursued during this pandemic. Overall, they're effective at short-circuiting financial sector collapse. So the off-the-charts downturn of the do-nothing scenario, some of these horrible numbers that you saw, remains counterfactual. We've tightly mapped the real-world programs to the model. The PPP are fully guaranteed forgivable bridge loans. The Main Street Lending Facility is a partially guaranteed bridge loan. And the corporate credit facilities are mainly the secondary bond market purchases. And of those, the PPP is the one that's the most effective, but there are synergies with other programs in general equilibrium. Now, an ideal, more targeted program would be slightly more effective, but would be less than 50% of the cost. The model does predict a high cost for these programs, a big rise in primary deficit to GDP. But again, bailing out the financial system would cost at least as much. There's, of course, a range of extensions we could pursue, but I'll kind of stop here in the interest of time. Thank you.
Perfect. Thank you very much, Vadim. And we're going to have Jonathan Payne now presenting the last paper before we go to the discussion. The paper is COVID-19, Inflation and Deflation Pressures. Thank you.
Okay. Thank you very much for putting us on the program. This is a joint work with Marcus, who's also on the call, and Sebastian and Julie. So as has already been discussed, I think it's pretty clear that the COVID crisis has brought sort of widespread changes to the economy, shutdown of some sectors, disruption in other sectors, large increases in government spending, and on a lot of measures, high volatility or uncertainty. All these different changes have led to sort of subtle and complex inflation or deflation dynamics. So what we do in this model is we try to understand what these inflation or deflation dynamics are going to look like. The model is going to have some similar features to the previous presentation, although it's going to be a lot more stylized. And in this, we're going to really try to focus on the link between inequality, volatility, and money or safe asset demand. Okay, so what do we end up getting when we do this? Well, first of all, we see that absent monetary or fiscal policy, we see a strong deflationary force during the pandemic, because we see the agents responding to this increase in volatility by trying to reallocate the savings into money or safe assets. We then think about a stylized government lending program. We show that this really leads to agents in the shutdown sector gambling on recovery. And this means that the inflation dynamics end up being amplified a lot or much more exposed to the length of the pandemic, where if the pandemic is short, we end up with more like an inflationary force through the pandemic. But if the pandemic goes on much longer than people expect, then we end up with a much stronger deflationary force. And finally, we think about redistribution across the different sectors. And we show this ends up being inflationary, even though both sectors in this model are going to have the same marginal propensity to consume out of wealth. So it's going to be a different channel to what you see in the Hank-style literature. Okay, so the main results. There's a lot of literature on this. I'm not going to go through it. I apologize if I've left anybody off. So I'm just going to give a sort of a highlight of the model here. So it's a continuous time infinite horizon world, and there's a continuum of agents with log utility for simplicity. And these agents are in one of two intermediate goods sectors, which I denote by this I. And the agents in these sectors produce according to an AK production technology, where Y is the output, A is the productivity, and K is the capital that they hold. The difficulty is that this capital is subject to idiosyncratic Brownian shocks. And the volatility of these shocks, right, the DZ of the shocks, the volatility of these shocks, sigma, is related to this kappa variable, which is sector one's share of capital in the economy. So we have a world here where as we move away from the steady state, we get a disruption to the relative capital allocation between the two different sectors. We end up with higher idiosyncratic volatility in the economy. We can talk at the end when we have more time about potential foundations for this. Here, we're just going to take it as given for this short talk today. We model these shocks, these idiosyncratic shocks here, as capital volatility, although we could also think about this as liquidity shocks or some other source of idiosyncratic risk that's getting larger during this crisis. We use capital shocks here largely for simplicity. Okay, so then finally, the goods from these two intermediate sectors are aggregated into a CES composite group good that's used for consumption and investment. Okay, so how do we think about the pandemic shock then? So a little bit like in the previous paper, the pandemic shock is unexpected initially, it then ends with a Poisson process with a rate lambda. And although the agents don't expect the shock to come, they understand the probability of the pandemic ending. What happens during the pandemic? Well, we have a decrease in productivity. So before the pandemic, both sectors have the same productivity. When the pandemic hits, the productivity drops down in the affected sector, which here is sector 1. Post-pandemic, it returns back. Okay. Finally, the final part of the environment we need to understand are the asset markets and what the government is wanting to do here. So in this world, there's only one financial asset. That's a short-term bond paying interest rate, IT. This is issued by the governments at some growth rate and is ultimately going to be valued as a bubble-like asset in the economy for its ability to ensure the idiosyncratic risk. But the agents are also able to issue bonds, but these private agents issuing the bonds, they're subject to a borrowing constraint. So they have this friction on their ability to issue. Then we have competitive markets throughout this environment. We have a competitive market for the final good and for the intermediate goods. The key difficulty in these markets is that the capital can only be traded within the sector. So this is a model where it's not possible for a restaurant that's shut down to sell its capital to Zoom. So we have a different capital price in each of these different sectors of the economy. Then finally, we have the price of these bonds, which you will think of as Q. And I'll refer to P, this one over the price level. So as the average price level in the economy. Okay. Then finally, we need to think about what the government is going to do. So the government here is able to transfer and tax. There's then a set taxes or transfers proportional to net wealth of the agents, but potentially with different transfers between the sectors. So the government can think about reallocation across these sectors. Okay. So what ends up being important for understanding the dynamics of how this economy is going to evolve? Well, there are a number of key state variables that are going to emerge. So one is this ADA variable. So that's the share of wealth that's in the shutdown sector, sector 1. Then we have this kappa variable, which is the share of capital that's owned by sector 1. This ends up being an important state variable because the agents are not able to trade capital across the two different sectors. And then finally, we have the productivity of sector 1. So these are the key state variables that we're going to need to keep track of and understand in this environment. Okay. A nice feature of this model, in some sense, the way it's designed, is that we're able to get a lot of analytical results. It's quite an analytically tractable model. But I'm only going to do one slide of maths for this talk, given the time constraints. And I'll just do that here and think about what are the forces that are going to drive bond prices in this model. So in equilibrium, the average price level, or 1 over this bond price, is the supply of bonds, that's this BT is the government supply of bonds, divided by the demand for bonds in the economy. And the demand of bonds in the economy has 2 components. One component is the portfolio share that the agents on average want to hold in these bonds. And the other is the net wealth of the agents, this NT. And we can think about what drives these 2 different components of bond demand. So if we think about this var theta, this portfolio share in bonds that the agents want, it's driven by a number of things. So primarily it's driven by this desire to try to ensure this idiosyncratic risk in the economy. So we see that here in the first term. So one term is really about the level of idiosyncratic risk, this sigma tilde. And then the second term is really about the distortion in the allocation of idiosyncratic risk between these 2 different sectors. That's what this second term is about. So we see that this, so that's the first part. And we see that this benefit of ensuring idiosyncratic risk with the bonds is partially offset by the signerage tax, by some distortion to the recovery exposure in the economy, and ultimately a Lagrange multiplier on the borrowing constraint. Okay, so we're able to understand a lot about what drives this portfolio allocation decision. We can also think about the net worth of the private sector, which is the other part of bond demand. And here we can see that net worth is essentially proportional to the capital stock in the economy, where what makes it proportional is really this average, this script A, which is the average productivity across these two different sectors. Okay, so just to highlight what end up being the two sort of big forces then affecting bond prices in this economy, well, the big deflationary force comes from this increase in idiosyncratic risk and this misallocation of idiosyncratic risk exposure across the sectors. This increases a desire to move into the safe asset of bonds to ensure this idiosyncratic risk, driving up bond demands and pushing down the price. The big offsetting effect comes from the decrease in productivity, which really decreases the net worth of these agents and causes them to decrease their bond demand. Okay. So that's all I'm going to say about the sort of analytics of what we can understand about what goes on. To try to help illustrate what's happening, I'm just going to do a number of simulations for illustrative purposes to think about the different effects. So first of all, I'll start with the baseline with no monetary or fiscal policy. Then we'll think about a stylized government lending program and a stylized transfer program. Okay. So let's start first with the baseline model. So what I plot here in the blue plots, or the blue lines, I plot the economy if we never recover from the pandemic. And then for these dashed lines, I plot recoveries at different points in time. So we see the productivity in sector A going down. We have the three state variables across the top. So we see the productivity in sector A going down. Then we see the share of wealth in sector 1 also going down as the pandemic wears on. And then we see the decrease in the share of capital that sector 1 has, although the capital decreases less quickly because sector 1 is not able to sell all the capital to sector 2. Instead, they gradually have to destroy it, and they're reluctant to do that. That's costly for them. Eventually, though, this capital gets destroyed and this idiosyncratic risk starts to rise and people reallocate into money. And so we get this deflationary force coming out of this model. Okay, so let's think about a couple of experiments then. So first of all, what ends up happening if we have a lending program? So here I have in the blue line, the no policy where agents face these borrowing constraints. Then with the red line, I think about what happens if the government facilitates lending between from sector 2 to sector 1 to overcome these frictions. So in the blue line, we have what we had before, but then in the red line, we see that, yes, indeed, the shutdown sector wants to take advantage of this lending program, and they really do want to borrow and lever up. And the reason they want to do that is because early on, they would much rather borrow than destroy capital. And we see the effect of this in the evolution of this kappa variable, right? So this red line ends up with a lot more curvature than the blue line, because early on in the pandemic, the agents are borrowing to avoid the capital destruction. But of course, as they become indebted, their net worth relative to the other sector starts to fall much more quickly. And eventually, they end up so indebted that the difficulty of paying back means they're going to decrease their capital stock more quickly. And so we see this curvature where eventually this kappa becomes steeper. How does this end up playing out in terms of the inflation forces in this model? Well, initially, the fact that the firms are not required to sort of shut down or destroy their capital stock gives us an inflationary force. But as they sort of gamble on the recovery and lose, we end up with a much stronger deflationary force in the environment. Finally, then, we can think about the other policy, which is a transfer policy. So here we think about the transfer between the two different sectors. In this case, we really prevent the relative wealth inequality from falling down. And in this case, we see that, yes, the kappa does not get disrupted in the same way. So we see that the prevention of the wealth inequality emerging means that the shutdown sector is able to hold on to much more of its capital. It's not forced to destroy its capital to smooth consumption. Ultimately, this means we don't get the same increase in idiosyncratic risk. And so the other forces, the forces on productivity win out. And we get inflation dynamics rather than deflation dynamics coming out of the model. Okay. So these were the stylized policies I wanted to talk about to illustrate what's going on in this environment. So just to close up then, I've tried to stick to the time, at least on my clock, I'm sticking to the time. So just to sum up in terms of what we got here, so we see that absent policy, we get a strong deflationary force. We see the gambling on recovery means that initially we get inflation, then deflation. And we get that the intertemporal redistribution dampens all these deflationary forces by not requiring the shutdown of businesses or the destruction of capital. What we haven't talked about here in the interest of time is what would optimal monetary policy look like. So in this model, targeting a constant inflation rate through this crisis is somewhat problematic because you end up with a much steeper decline in investment because of a bigger drop in capital prices. So really what comes out in this world is you want the central bank to increase inflation during the pandemic to dampen this precautionary saving behavior as the agents are crowding into these money-like assets or safe assets. Of course, what makes this difficult and what we haven't characterized in this talk is they also have to worry about the misallocation of the aggregate risk across these two different sectors at the same time. Okay. So at least by my clock, that means I'm out of time. So I'm going to leave it there and say thank you and go over to the discussion part of the seminar.
Fantastic. Thank you very much, Jonathan, for the presentation, and to all the presenters. I want to remind the attendees that if you have questions for the panel, either specific on a paper, but also sort of broader questions that might link a number of papers, feel free to put them in the Q&A box. I want to start out with a question to all the presenters, and that one of the things that I found interesting across the various presentations is, the various analyses of the roles of policy, largely by the Fed. First two papers, Antonio and Alan looked at financial markets, and then the last two papers, Vadim and Jonathan just now looked at the real economy and the role that these interventions played on the real economy. And I want to sort of think about a broader question. First of all, do you guys view the various policies as successful? What could have been done different? I guess, Vadim, you guys talked a little bit about that, talking about targeting more optimally. And I guess Jonathan talked about optimal policy at the very end, but what could have been done differently? And then, thinking about some of the Fed policies, should they become part of the standard toolkit? Given how effective they looked in some of these things, should we do things differently? So I want to open it up. I don't know. Maybe we'll go. We start with either Alan or Antonio, thinking about the financial market side, and then go to the real side afterwards.
I can start. So two things on that. First, the measurement effects of them are very powerful, in particular because they were kind of unexpected, right? So that's we have to have in mind. Our main tool is kind of an event study tool, and the traditional policies are typically expected, and then this is naturally when you do something unexpected, you're going to find bigger effects closer to the true effects of these policies. That's statement one. Statement two, of course, this opens while they were effective, the opposite obviously opens a can of worms. Before the Fed used to provide liquidity to banks, and the banks would try to provide liquidity to the economy, and the Fed would regulate, have a fairly good picture of banks and regulate them. Now, if you're providing liquidity directly to the markets, what is the regulatory backstop here? Maybe so. That's a can of worms that we're going to have to wrestle with as both regulators and academics. I think a salient point to think about is in particular mutual funds and their role in propagating these things, as like Antonio emphasizing in his talk. And that's probably is going to be a place where the regulatory scrutiny should be going after, because that's it seems to be a point of fragility. And then I agree with the author's conclusion that that's what the Fed seems to have done, is to provide liquidity to them. So at least in part. So that's my two cents on this.
Antonio, Itay?
Yeah, I'll say a few things and then I'll let Itay chime in as well. So I think in terms of, just to elaborate a little bit more in terms of sort of what we think we learned from what we sort of expected on the one end and what we think we learned afterwards from what we found in the analysis, I think a little bit. So what we expected is, we thought, sort of based on our priors, that there would be some effect on funds, but we were a little bit surprised on the on the higher end of the spectrum in terms of the size of the effect. So it was clear that generally both right away, right after the announcement, we saw this kind of relatively quick positive effect of both policy announcements, and then over the longer time period that I discussed toward the end of the talk. In some sense, the benefits were more long-lasting than a very naive sort of view of what the announcement would have implied. So clearly, there was a kind of a prolonged benefit, and in some sense, it's kind of surprising that the size of the purchases wasn't so large, right? But even just the eligibility, so that kind of speaks to this liquidity backstop idea and market maker of last resort. So clearly, even just the eligibility had pretty large effects, and it was just not even just on the funds that had eligible bonds, but also the spillovers that we do find sort of speaks to this kind of broad-based kind of benefits that the facilities had on funds. A bit of an angle that this opens is this question of macroprudential versus microprudential. So I'll let it elaborate a little bit more on there. So the funds are, of course, relative to banks. This kind of are a bit of an interesting animal, because how to regulate funds is a bit of a broader question that So Itay, I'll let Itay elaborate further.
Maybe I'll just add a short comment here. I think it certainly has been successful, the intervention of the Fed. I think a year ago, not many people believed that the Fed would come in and buy corporate bonds, and it turned out they had to do it, and it worked. So I think people look at it as a success. But I think going forward, I don't know if we should expect the Fed to do it every time there is a stress in the market. And I think that the way to think about it going forward is to try to address some of these underlying fragilities in financial intermediation in the bond market and more generally. So things like requiring capital buffers in funds and swing pricing and other tools that have been either attempted or discussed in policy. I think we should look more into them going forward.
Great. Tim, Vadim, Steen?
Sure. So one thing, you asked about the different kinds of policies that the Fed was using, and in our model, we kind of were able to break down to a certain extent, okay, this is kind of how we think about the PPP program, and this is how we think about the MSLP, and this is how we think about the corporate bond purchases. And one result we kind of got was that by far the most efficient way, at least in our model framework, to support the real economy was through this PPP program, so these forgivable loans where banks did not have to retain anything, because those directly address the kind of liquidity problem of firms, and they prevented, corporate defaults. And these corporate defaults, if they hadn't been prevented, they would have basically triggered like a breakdown of the financial sector. I mean, that's kind of the key takeaway from our setup. Now, then in hindsight, now there's some other aspects. For example, if you read about this Main Street lending program, there was hardly no uptake in that program. And if you listen to what the Fed says, okay, banks were not interested in extending the loans because they were not interested in retaining even 5 to 10% of these loans, right? So that's of course something that we don't really have in our model yet, and we might need to think about still. But I think there's some conclusions here for like what kind of this program design should look like to basically be effective going forward. I don't know, Stein, Vadim, if you want to add anything.
Yeah, I mean, I would just say that, in thinking about the financial sector, I think strikes me as pretty important in terms of understanding the spillovers to the rest of the economy, to the unaffected financial firms, the firms not directly hit by the COVID shock, but then also to the household sector. A little bit outside of the scope of our program is, of course, government programs that directly transfer resources to households. I think that'd be an interesting aspect to add to the analysis here, and to kind of contrast interventions that target the consumer versus interventions that target the firms.
Have you guys thought a little more practically how better targeting might be achieved? I guess there's always a question, if you have to act fast, then there's obviously limitations. But if you're going to try and design this program sort of upfront, how would you do this optimally? With sort of the hindsight of where the targeting went wrong, quote unquote, with say the PPP program.
I mean, in our program, there's actually not a lot of welfare loss from imperfect targeting, which is, I think, interesting. It suggests that the blunt unconditional loans were actually quite effective. In part that's because if these loans are available and prevent default, then the firms can pay them back, right? So if everybody can pay back their loans, there isn't really much to be gained from better targeting.
I guess PPP was forgivable even for people that didn't need it, right? So I think that in many ways seems the least well targeted program. Anecdotally, I've heard of a lot of small businesses that took it because they could, and it was in some sense it was free money, but they wouldn't have laid off their staff even in the absence of it. So I think that's a program, and it's kind of the biggest one and an important one in your model too. And so thinking about how to better target that, I think will be an interesting thing for for researchers to figure out going forward.
Definitely.
Johannes, I think we when I gave the example of kind of how you could think about this larger dispersion, right? I talked about industries, right? So that's an easy way, right? That's something that a government can judge very quickly. But I mean, then we're getting into kind of the politics of, is it going to be targeting based on optimal industries or about best lobbyists? And, we stayed out of that.
Yeah. Jonathan, Marcus, do you want to talk a little more about the optimal policy that you kind of, alluded to towards the end? How would that have looked different from what happened?
Should I, Jonathan, should I first or?
You're unmuted, Marcus. You're welcome to go. Welcome to take it.
So first of all, I would like to say that if you compare 2020 to 2008, going beyond the paper, essentially, the Fed and the fiscal authorities reacted much more aggressively, and that's actually led to a very different outcome, as we have seen. And it questions whether we were not aggressive enough in 2008. So in particular, any problems on the household side and the banking side did not materialize at all. While, we now see much more problems on the corporate side, on the firm side, and I expect much more research to go on the firm side rather than focusing on mortgages and households and all that, because the whole problem through the CARES Act and the Fed interventions moved in a different direction. In this regard, I see it as a big success at this point, as far we can evaluate it. And might even question whether in 2008 we were too timid in terms of preventing not bigger damages in 2008. In terms of the policies now, we don't know yet how things will play out. We will have a large fiscal deficit and high debt numbers. And then the question is, how to evaluate these debt numbers and how would be the inflation impact of this. And there's something like, the inflation dynamics I find interesting. That's what we tried to capture, and Jonathan presented this idea that it might be that we have initially deflationary pressures and later inflationary pressures, and how this dynamics will play out. And there are two different traps you might end up, and what explains which trap you will end, deflationary trap or in the inflationary trap. And, things have not played out yet, but you can see it already on the inflation expectations that there's much more disagreement. Some people think we move into high inflationary territory. Others think we move into very low, long-lasting deflationary territory. And I mean, that's the big tensions I think one has to say. And so whether the current policy is the optimal one, that's hard to say. I think it's what's important. I think the lessons we can probably draw at this point is that it's very important that you have an independent central bank and you impose macroprudential regulation to make sure that if inflation were to pick up, you can step on the brakes, or if deflation will be locked in, that you can stimulate the whole economy. So it's more like how to maintain space to move around, essentially, as things either get stuck in deflation or you move into high inflation territory, and how to manage these things. And that's I mean, I'm speculating here beyond the paper, but that's what the paper tries to achieve in the bigger picture, and what are the different forces to understand, you know, what we have to look out for.
Can I interject with a question from the audience on exactly this point? So there's a question on the time difference on average in your model between, you know, these moves between the inflation and the deflation period. What was sort of, is this something that you would expect to see relatively quickly, or is this something that might take a long time?
By time difference, you mean what's the length of a period in a sense?
Yeah, exactly. Like how, you know, over what horizon do you think you might see switches between these regimes?
So what we did not do is essentially we didn't calibrate the model. This is just an illustration of what the different forces are. So there's not a calibrated model. It's just trying to understand the various forces. Of course, if you move into deflation, we see already lower inflation. And if this locks in, this might last longer. The question is, if you have this inflation whipsaw, what I call this inflation whipsaw, that, you know, first deflationary forces and then inflationary ones, when will you see the switch over to the inflationary forces? For this, the model is, you could calibrate and get something in, but it's probably too stylized to get to this. But this probably would materialize in the next 1 or 2 years, whether you see the inflation picking up. And of course, we have a different, what the model does not capture, we have now a different Fed policy framework as well with the average inflation targeting, where the Fed says, okay, they will let the inflation come up and intervene actually very, very late. And this might have implications as well. And the model does not incorporate all of these elements. So we just, as Jonathan pointed out, we just looked at 2 particular policies. One is having some lending policy, what are the implications of lending policies. So the people are not lending constrained anymore because there's some lending frictions are removed. And what are the others if you redistribute from one sector to the other sector, and what are the dynamics on inflation coming from these 2 policies? But there's more to be done.
I think ultimately the model would say it's to do with the speed of recovery in productivity relative to the rate at which sort of idiosyncratic risk starts to fall again, or at least perceptions of idiosyncratic risk start to fall again. That's really the ratio that determines the speed at which you would flip from a deflationary dynamic to an inflationary dynamic. And so I think the model would say that the difficulty for the Fed is trying to understand when that, when we kind of flip, like how fast those 2 different forces are moving. This sort of belief about future uncertainty or idiosyncratic risk, and this sort of recovery and productivity in these sectors that have been really struggling over the past year. And that's what the model would highlight. In a model, we have another version where we have a sort of stochastic recovery rather than a plus on recovery. And there, it really does depend on the speed of these 2 forces, how you get this inflation whipsaw. Just to add a little bit to that.
Perfect, thank you. So I want to go to Stefano, and one of the things that I thought was really interesting across a number of papers was the fact that as we're going into the crash, there seemed to be very, very little concern on part of investors about actual cash flow stocks. So we saw that in Alan's paper, you know, the differences between the high yield and the corporate debt was actually pretty small, which is, you know, in some sense, way we'd expect cash flow stuff to show up. We saw, you know, there's a Ralph Kogan has a paper that shows, you know, using dividend strips that really concerns about cash flows are hard, you know, weren't really that big. And you know, in the presentation Stefano gave, the expectations of the retail investors about declines in GDP growth are really quite minor, and yet you saw this huge, you know, huge crash in prices. And so, you know, I want to get Stefano's take on that, and then maybe bring Alan back in on sort of, you know, 2 things. First of all, what, sort of more speculatively, why were, as we are going into sort of March, April, on the, you know, on the investor side, why were people not more worried about the real economy? Is it that they were already, you know, there was already first signs of this government coming to the rescue happening, and so, you know, people thought, you know, people realized there's going to be a huge bailout? Is it that, you know, in March people hadn't realized yet that we're going to be in lockdown still 9-10 months from now? And you know, if it's not the cash flow side, why the big decline in prices?
So this is a hard question.
I know, I left it last for you.
It's a difficulty, but my kind of gut feeling is that I don't think anybody would have guessed that they would have the huge bailout. So I strongly doubt that if there's one thing I can kind of be confident in excluding, is that people anticipate these huge economic effects and then a big bailout. That's probably not what's going on. I mean, it's kind of interesting. If you look at the previous pandemics, over the last hundreds of years. And, Steve Davis has a recent paper about that also that looks at that, and Bloom and so on. It seems like the actual, the human life effects of pandemics have been devastating, right, in the past. But the actual economic effects has been much more muted, simply because these pandemics have been very short-lived. When you live through it, they seem interminable, but it's actually only a couple of years. And in the past, the governments did not have these huge bailouts that we saw today. And if you look back in the past, indeed, the economy didn't suffer as much. And so I think, my kind of gut feeling would be that the investors, by comparison, first of all, just one more thing, which is many of the episodes that look like they would be like pandemics, they didn't actually materialize into full-blown pandemics. So that's part of it. And part of it, I think, is investors look at the past and say, look, in the last 100 years, these big pandemics did not have huge economic effects. And indeed, they did not. And so what did least, so that's, I think, kind of justifies the initial low response. And then for the ex-post response, was kind of an overreaction, because as you mentioned, it's very clear that this drop in prices could not have been justified fully by fundamentals, even without bailouts, basically. And so I think that that's just, either, panicking of some sort of liquidity or forced selling by some investors, but whatever we call discount effects.
Yeah. Marcus, you have.
I have a quick question to Stefano. There's this narrative out there where I say you don't want to lose out because they run up again. So like in the last crisis in 2008, there was a drop in the stock prices and then the recovery, and many people lost out, were not part of the ride. And did you find your service can use that there's a sense of, I don't want to lose out the recovery, and hence people moved in very aggressively again? Are your service revealing that? And then I have a second question. By flipping your beliefs, I thought it's very much like a Harrison-Krebs or Shenkman-Shaw type of model, that the optimists become pessimists, the pessimists become optimists. But would you say this model is explaining well what's going on, or is not, because there's not enough trading? Because this model would also imply a lot of trading. So it has these belief switches, but it doesn't have the trading thing. Perhaps you can do it.
So these are great questions. So let me start with the second one. Indeed, so first of all, we didn't calibrate this model to these kind of models to our data. So do the belief switch in this kind of way? Yes, because the pessimist becomes more optimistic and the optimists become more pessimistic. So you certainly have this switch in beliefs. Indeed, one of our main results is that the trading is very muted. What are the quantitative effects? Is there enough switching, enough trading to justify, to kind of fully kind of explain price movements? This I cannot answer to you because we didn't do a quantitative calibrations. But yeah, the gut feeling is probably that this would not explain sufficiently. But it's complicated, right? Because, in a very liquid market, or in markets where nobody moves, where nobody trades, even small changes in trades can actually have big price effects. So the answer is like, I cannot tell you for sure yet until we do a more serious calibration. And in the other part, the fear moving out or missing out on the kind of price recovery, we don't have directly that. So it might be, so we don't have anything that speaks directly to that. We do see that people became very pessimistic and yet they didn't pull out. So there might be a reflection of that, but I don't think we can directly, we don't have anything that directly allows to see if that's what's going on in their minds, basically.
Let me add one thing, Marcus, on that question, because we have a new question in the survey, which we haven't spent a lot of time exploring yet, but where we ask people, what fraction of investors do you think are more optimistic than you or more pessimistic than you? And so one of the things we find is that while everybody became more pessimistic, they thought that everybody else got even more pessimistic. So actually people's perceived relative position in the belief distribution stayed, actually went up even as they became more pessimistic. And so I think that's going to be a really interesting moment for us to focus on, to try and exactly figure out these types of questions. Because I think, in general, just in terms of the dynamics, we've only looked at sort of, average beliefs, but you can actually see that holding your belief fixed, your portfolio position varies with where where this belief puts you in your, relative to others in your own mind. And so I think during this period there was a lot of shuffling around of that as well, and I think that's going to be
and this for the next paper.
That's going to be the next paper.
One thing I would add as well, Johannes, to your question is that there's a lot of cross-sectional dispersion in the effects, right? There certainly are companies whose fundamentals have kind of more persistently deteriorated. And there, I think you do see like large and kind of more permanent price effects. You know, just think about like hotel REITs or things like that. Yeah. So certainly there are, there are places. Some of this is technology firms that are a large part of the market have kind of done very well, and that has offset some of the larger declines and a large swath of the other sectors.
I think one other sort of theme that I think was strong in also particular Antonio's presentation is that I think this period really forces us to do, and a lot of people have started doing work on this, and I think we need even more, is thinking about the elasticity of prices with respect to quantities, right? So, Antonio saw these very large, relatively large flows in and out of the bond funds. But on the retail investor side, I think, Stefano's presentation showed there wasn't, there were obviously movements, but there were orders of magnitude smaller than what you get out of a frictionless model. And I think, here, like coming also like, Alan's last slide, like a frictionless model just isn't going to get us, because if you move expected returns around by a few percentage points, the portfolio shares should dramatically shift. There should be like 30, 40 percentage point shifts in portfolio share. And yet, you see relatively little. And then, to the extent that you do see movements, say in and out of bond funds, the price impacts are pretty dramatic, right? And so I think this was really an episode where my sense was the quantity movements were quite small relative to the belief movements, and yes, the price movements were huge. And so, this work that, say, Ralph and Modo and Xavier and others have thought about, also trying to figure out, how to make sense of these large price movements, even though quantity movements are comparatively smaller. I think there's a lot more that we need to learn. I think this was an episode that really highlighted this, very strongly. And I think, particularly Antonio's presentation is very, something very salient to me when watching that.
Just to follow up on that, you can have a model where there's only price movements, updating price movements, and there's no quantity movement at all, no?
Sure, I guess, yeah, but I guess the question is, that's right. So I think that this comes to some of what Stefano said also. There is, if only very few people are trading, small trades can have huge price movements, and you can take that to the extreme where you don't need any trading at all. I think that the question that surprised me more is when you go away from a representative agent model, where you're almost getting that by definition, the types of heterogeneous agent models when you then have movements in beliefs in these models, the quantity shifts that they imply are much, much, much larger than any of the quantity, even the in and out of bond fund quantity moves that Antonio and Itay get in their paper. And so trying to figure out how, what it is in the markets that leads to these large price movements, despite that, I think is going to be an interesting exercise.
But Johannes, Antonio, maybe you should, I understood that you guys showed big quantity changes. I think I agree with you guys that we need to link like beliefs, quantities, and prices. But quantities, I think, moved a lot. I mean, at least if you look at these flows in bond funds, and of course we didn't see the whole play because the Fed came storming the barn. So I don't know. I wouldn't. I don't know. It's definitely not my conclusion that quantities didn't. I understand that Vanguard. That's not what you see in the Vanguard survey, but yeah, I don't know.
So I guess the question is, like, for the few percentage points shift in portfolio, in a frictionless model, what shift in beliefs would that correspond to? And it's a relatively small shift in beliefs, right? So that's I guess.
Right. I think that's fair. Itay, do you want to chime in?
No, I agree with Alan. I think my take on it is that the quantities were fairly large. If you look at them at historical perspective, you're talking about outflow funds losing 10% of their assets, and I mean the key point in our paper is also to look at this liquidity and vulnerability dimension, and to show that the outflows are much bigger in those funds that are more illiquid and more vulnerable. So I think over there you did see very significant quantities. Maybe not when you look at average across all funds, but when those frictions become more severe in the illiquid funds and the more vulnerable funds, I think you do see very significant quantities.
So putting these two papers together, just a quick question. Could it be that the Vanguard investors are a special class of investors? They're much more passive and they're not representative of the average investor in the financial markets. So Itay and Antonio they have the fickle investors, and Stefano and Johannes have essentially the sleepy investors.
So it's possible. I mean, I just want to, it's hard to know, of course, because we don't see the comparison with the rest of the investors, but we did look in the other paper. We did compare under many dimensions our investors to the standard investors. For example, the standard performance, flow performance relation that we see in our investors is the same as what you find in the general population. So, the average trades of our Vanguard investors are the same as average trades, let's say the frequency of trades for other big investors. So certainly they're different in some dimensions. They're a bit older, they're richer. We don't actually have very good data to exactly pin down the differences, but it's an interesting puzzle to see how you justify these big bond flows where we see much less in our data. That might be part of the explanation.
Stefano, do you look at equity versus corporate bonds, or?
We did. We split the equity share, the fixed income share, and cash. What you do see flows out of equities and out of fixed income into cash, but they're small. And how do you reconcile all these quantitative is difficult because we observe only a segment of the population.
Yeah, right.
But we didn't split corporate versus.
No, we didn't split corporate versus treasuries.
Oh, okay.
We just did fixed income as a group.
Yes.
Yeah, but treasury is also the evidence that it hit them too. It was not 2008 where treasury was having this. Was the safe haven. I think in March you saw treasury being hit very hard with sales as well. Perhaps even more than corporate debt. I wouldn't.
But we could, by the way, we could also split separately. We can actually look specifically at bond funds, for example, right? So we can try to mirror exactly this kind of analysis.
Marcus, I think you were.
I just want to say that the US 10 years treasury was mostly hit from foreigners now, to a large extent.
Yeah, I mean, we know the prices moved up a lot. Volatility was wild. And we see some flows. That's what we can see. But data is very imperfect, right? On holdings of treasuries. I don't know. For me, the jury is still very much out on that one.
All right. Well, this webinar, we're going to get cut off right exactly at as you guys probably experienced in other sessions too. So rather than having one of you getting cut off mid-sentence, I'm going to use this as an opportunity to thank all of you for presenting and for participating in the discussion. As everyone's seen, I think there is we've learned a lot over the last 9 months. It's kind of impressive, how many COVID papers there have been, both in finance and in the economics profession, more broadly. So, I think we've learned a lot, but there's still a bunch of open questions. And, a lot of the papers we saw today have, focused on the immediate impact in the financial markets. I think there is interesting stuff to understand about sort of the longer run impact too. So lots of work to be done for all of us. Thank you very much, everyone. And, I hope you all have a good rest of the AFA.
Thank you, Johannes, for the great session.
Bye, everyone.
Thank you.
You.